There are certain names in the financial world. They do not appear on screens, they do not speak loudly, and they do not make grand prophecies about the market, but with the systems they build behind the scenes, they altered the direction of the entire investment world. David E. Shaw is at the forefront of these names. Viewing him merely as a successful hedge fund manager would be a major understatement, because Shaw's story begins at the intersection of computer science, mathematics, and financial markets. We are talking about a scientist who does not come from a traditional Wall Street background, holds a PhD in computer science from Stanford, and pursued an academic career at Columbia University. When he stepped into the market, his world was not one of broker desks, crowded trading floors, or intuitive trader reflexes. It was built on algorithms, data structures, computational power, and mathematical modeling logic. This outsider perspective allowed him to treat financial markets not with traditional cliches, but as a massive data problem to be solved. The most fundamental element that separates David Shaw's approach to technical analysis from classical methods is his focus on mathematical repetition within the data, rather than on the chart itself. Frequently asked questions in classical technical analysis, such as, "Has this trend line broken?" or "Did this pattern work?" mean nothing to Shaw. Instead, the system questions whether this price behavior has repeated thousands of times in historical data and whether these repetitions have generated a statistically measurable, sustainable advantage. Visible geometric shapes can be an illusion of the human brain finding order among random data. However, for Shaw, a true pattern is solely a behavioral mold that can be mathematically verified within the data. This philosophy uncovers structures referred to in financial literature as ghost patterns. These patterns are anomalies that cannot be easily explained by economic reasons, appear random at first glance, but are proven to be non-random through deep statistical testing. Shaw and his team built their systems upon these invisible microstructures by identifying these blurry areas where the market is inefficient. The most significant difference emerging here is that the financial advantage of patterns that are easy to explain and notice depletes extremely fast. A classical trader generally prefers structures that can be seen by everyone, such as triangles, head and shoulders formations, or obvious support and resistance levels. However, according to Shaw's logic, the more obvious and crowded a market structure is, the faster the advantage it offers, the market edge, disappears. If everyone is waiting for the same breakout and entering orders at the same level, market liquidity quickly drains that advantage, leaving nothing but noise behind. For this reason, Shaw turns to anomalies that are the hardest to notice in the market, require complex mathematical models to test, and seem to have no logical explanation at first glance. The more hidden a pattern is and the more computational power it requires to scan, the higher the probability it has to generate a lasting edge. This approach goes far beyond simply making decisions based on whether an indicator enters an overbought or oversold zone. A real advantage is only possible by reading price behavior, volume profile, volatility fluctuations, order book liquidity, timing cycles, and the market microstructure as a whole in correlation with one another. In this regard, Shaw's methodology starts directly from data, not theory. Traditional financial theories first put forward a macroeconomic assumption and then try to fit market data to this theory. In quantitative modeling, however, the process follows the exact reverse order. First, raw data is collected. Then, recurring microscopic behaviors are isolated through data mining. These behaviors are subjected to comprehensive backtesting on historical data. The structures that successfully pass the tests are turned into a mathematical model, and in the final stage, they are integrated into the system with a rigid risk control mechanism. Financial models are never accepted as absolute or uniquely correct structures. On the contrary, the market is a constantly changing, dynamic, and nonlinear complex system. Real value lies not in the theoretical elegance of complex equations, but in flexible structures that have been tested repeatedly and have survived under real market conditions. Although the D.E. Shaw structure is often perceived merely as a high-speed quantitative fund, the actual technical advantage does not consist solely of transmitting orders at the millisecond level. The real power lies in being able to capture small price anomalies that others cannot see without advanced analytical tools, modeling them with the correct mathematical functions, combining a large number of independent small advantages under a single umbrella system, and executing them by diversifying the risk across a wide pool of variations. The millisecond speed race requires a massive capital and technological infrastructure, but what an individual technical analyst or system designer can learn from this modeling logic is not speed, but this methodological way of thinking, measuring instead of predicting, and building a process-oriented architecture instead of chasing a single signal is the key to success. To understand market mechanics, one of the most critical issues Shaw emphasizes is the ability to distinguish liquidity-driven price movements from information-driven ones. In a classical technical analysis approach, when a sharp decline is observed, it is generally assumed that there is a highly negative development in the market, or that the trend has completely turned into a bear market. However, a deep market reading forces one to ask this question: is this sharp price movement the result of new information, a fundamental development, or is it just a temporary liquidity imbalance resulting from a large fund's immediate cash need, forced position liquidation, or portfolio rebalancing operation? If the price movement is not based on a real informational shock but is distorted merely due to a mechanical flow, there is a high probability that the price will revert to its statistical mean within a short time. Large institutional sales can temporarily push the price out of its rational value, but once the liquidity gap closes, the market will find its old balance. This is of vital importance on the technical analysis side, because not every sharp breakout is the start of a real trend. Often, what is encountered is just a liquidity drain, a clearing of stop levels, or temporary imbalances created by market makers. Therefore, analyses conducted without establishing a volume and liquidity tracking system capable of making this distinction are doomed to be misleading. Managing this complex structure cannot be achieved by trying to find a single flawless indicator or a holy signal. Behind Shaw's success lies a signal pool logic that, instead of searching for a single perfect formula, brings together a large number of small and weak signals across different markets, different time frames, and under extremely tight risk control parameters. Weak statistical signals that remain on the edge of observability and seem almost meaningless when viewed in isolation transform into a powerful trading strategy when combined systematically and filtered for their correlations with each other. This is a holistic structural logic consisting of a combination of different sources in the market: volume, momentum, volatility, and price action. Instead of blindly believing in a single bar or a single signal, verification from different layers of market data must be sought. Moreover, these models are not static. As market regimes change and certain patterns become crowded, losing their impact, the system must constantly renew itself, removing stale signals from the pool and adding new ones. The fact that David Shaw approached the market not with a trader's reflex, but with that of a computer scientist and mathematician fundamentally shook the traditional structure of Wall Street. In his eyes, the market is a complex system that operates with incomplete information, constantly generates noise, contains recurring micro-behaviors, and can only be solved through computational power. The most common mistake made by those who perform technical analysis is the tendency to believe a method works flawlessly when they see 2 or 3 successful examples on a chart. The human brain is naturally prone to confirmation bias and only remembers the successful outcomes it wants to see. A scientific testing culture, however, demands the exact opposite. How many examples of this structure exist in historical data? In which specific conditions or volatility regimes does it work? Under what circumstances does it completely break down? When measuring the model's performance, can this structure survive in tests conducted on data the model has never seen, meaning the out-of-sample phase? Does a clear financial advantage still remain after adding transaction costs, commissions, and slippage? And most importantly, where do the most extreme risk scenarios the system might encounter begin? Every chart structure not verified by statistical tests is not a strategy, but merely a subjective interpretation. Handling risk management at an engineering level is one of the most prominent features of Shaw-style modeling. Many major crashes and failures in financial history have stemmed from assuming the market is too orderly, and that price movements always conform to a normal distribution curve. Classical statistical models calculate the probability of rare events, meaning tail risks, as nearly close to zero. However, in real markets, rare events happen much more frequently than financial theories predict. Liquidity suddenly dries up, correlations between assets turn upside down, and excessive leverage can shatter systems within a single day. A successful strategy design does not mean the strategy that makes the most money during beautiful days when the market is calm and trending. A truly good strategy is one that can protect capital and survive even on the worst days when liquidity vanishes from the market. Correlations break down and everything goes wrong. The fatal element in markets is usually not a wrong signal or an incorrect direction prediction. What is fatal is entering a position with a risk assumption too large for the system to bear. Over time, this rigid quantitative structure did not remain limited to the cold mathematical calculations of computers. It evolved into a hybrid model that combines quantitative data with fundamental and macroeconomic context. Today, this is called the quantamental approach. A machine can scan billions of rows of data in seconds and capture relationships impossible to see with the naked eye. But it cannot read the context of geopolitical crises, sudden regulatory changes, or moments when the market experiences a fracture due to social psychology like a human can. The correct model is an integrated structure where the machine filters the data and extracts structural anomalies, while the human brings the macro context and logical filter into play. The system generates the signal, and risk management filters these signals with strict rules. Indicators, oscillators, or scanning algorithms used on a chart should not be mechanisms making decisions instead of the trader. On the contrary, they should be positioned as auxiliary tools enabling the trader to think more clearly and with greater discipline, freed from emotions and noise. This holistic system perception becomes a permanent force when combined with an institutional research culture. Contrary to traditional approaches where egos, personal predictions, or market charisma come to the forefront, a culture dominated by data, scientific testing, rational arguments, and verifiability is the true advantage that is hardest to replicate. Any analyst who wants to be permanent in financial markets must build this research culture within their own inner world. The fact that a method works very well today does not mean it will continue to work in the same way tomorrow when the market structure and volatility regime change. Every strategy that becomes crowded in the market consumes itself over time. A pattern is found, tested, applied to the system, its effect diminishes as it is discovered by other actors, and the system designer immediately starts a new search, beginning the process all over again. To summarize, David E. Shaw is not a classical technical analyst chasing chart formations. He is a system engineer trying to capture recurring human behaviors, institutional order flows, and mechanical imbalances in the market using statistical methods. His approach reminds us that not every visual structure we see on a chart is a signal. A real signal is a comprehensive framework that repeats in historical data, is mathematically measured, verified by tests, generates a net return after transaction costs are deducted, and is kept under control with a dynamic risk management system. This is precisely where the difference between being an ordinary actor in the market and being a professional system designer begins. Ordinary analysts only chase instantaneous signals and results. Professionals establish the process, test the data, and manage their strategy with an engineering discipline. Real advantage lies not in the lines on the screen themselves, but in how you make sense of the depth of data behind those lines.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description.